This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Friday, August 7, 2026, and this is the New York session. Now, let's get into it. The U.S. labor market didn't just stumble, it contracted. With non-farm payrolls printing a shocking 23,000 against an 80,000 forecast, the dollar is facing its most aggressive repricing event of the year. We are seeing a complete fracture in the safe haven narrative, with gold surging to 4,265.14 and the fear and greed index collapsing to a fearful 14 out of 100. Let's dive into the data. Looking ahead, the calendar remains dense with critical data that will either validate or refute this labor market shock. First, we have the immediate aftermath of today's employment data, but the next major catalyst arrives on Tuesday, August 11th, when Australia releases its Reserve Bank of Australia rate decision at 4:30 UTC. Given the heavy positioning in Aussie crosses, this decision will be pivotal for Aussie yen and Aussie dollar flows. Then, on Wednesday, August 12th, the U.S. Consumer Price Index, CPI, drops. This is the definitive test. If inflation remains sticky while employment tanks, we enter dangerous territory for the dollar. Finally, retail sales land on Thursday, August 14th, offering a final check on consumer spending resilience before the weekend.
On the CPI release specifically, the market is currently assuming the non-farm payrolls miss is an isolated anomaly. The key watch is whether the CPI print aligns with the softening labor narrative or reinforces the existing 3.46% inflation backdrop. That divergence determines if the dollar sell-off accelerates or reverses.
As of 9:33 ET, the breadth of the dollar weakness is evident across the board. Euro-dollar is trading at 1.1523, effectively stalling in the upper half of its 5-day range between 1.15004 and 1.15596. Cable sits at 1.3453, testing the upper boundary of its 5-day range, which peaked at 1.3503 earlier in the week. Meanwhile, dollar-yen has retreated to 158.4155, approaching the 5-day low of 155.229 seen on August 3rd. Safe havens are leading the charge. Gold is up 0.3% to 4,265.14, nearing its 5-day high of 4,304.21, while the Swiss franc also sees strength with dollar Swiss down slightly to 0.812595. On the commodity currencies, Canadian dollar is bucking the trend. Dollar CAD is actually up 0.3% to 1.4018, driven by a massive plus 75. 1K employment gain in Canada compared to the U.S. miss. 3 headlines are dominating the flow right now. First, Forex Live reports, U.S. dollar sinks on shock contraction in jobs, highlighting the minus 23K non-farm payrolls figure. Second, the headline notes, Canada July employment change plus 75, 1K vs plus 15K expected, creating a stark North American divergence. Third, all eyes on the U.S. jobs report now, summarizing the market's fixation on this single data point. The minus 23K number is the catalyst, but the context is the 3.63% Fed funds rate. We are seeing a forced pivot from higher for longer to immediate cut expectations because the labor market has broken, even though core PCE remains stuck at 3.29%. The market is prioritizing growth fear over inflation persistence right now.
That pivot is reflected in the leverage. Leveraged funds have increased their yen net long position by 103,259 contracts week over week. They aren't just fading the dollar, they are actively rebuilding safe haven exposure in yen and euro, with euro net longs sitting at plus 1,269.
But look at the VIX. It's at 15.81, essentially flat, while fear and greed is at 14/100. That silence is dangerous. The options market hasn't spiked despite the spot market screaming risk. This disconnect usually precedes a volatility expansion that doesn't respect technical boundaries.
Let's start with the most direct beneficiary of the yield curve shift, dollar-yen. It is trading at 158.4155, sitting roughly halfway between the 5-day high of 158.575 and the critical low of 155.229. The 10-year 2-year yield curve has steepened by 0.44 percentage points, driven by falling long-end yields. Grid, what does the structure suggest for a move toward that 155.229 low?
Technically, the pair is in compression. The 5-day range is tight, and we are currently at 158.4155. The 155.229 level acts as the immediate liquidity grab zone. If we lose the 5-day midpoint, the path of least resistance is lower, but we need to see volume expansion on the breakdown. Right now, the consolidation suggests indecision. But the yield differential is the dominant gravity factor pushing this toward the low.
It's not just technical gravity, grid. The 10-year 2-year flattening means the US is losing its yield premium relative to Japan. The 3.63% rate is no longer enough to justify the carry trade when domestic labor data is contracting. The fundamental driver here is the yield spread, not just chart patterns.
And that's where the positioning gets interesting. Leveraged funds added 103,259 net longs to yen. They are betting on this yield convergence. But note the Swiss franc data. Leveraged funds are still short Swiss franc by 9,647 net. They see the yen as the primary beneficiary of the dollar shock, not necessarily the franc, which suggests a specific rotation into yen, rather than a broad safe haven sweep yet.
I'd caution against viewing this as a smooth slide to 155.229. The VIX at 15.81 is suppressing volatility, but the fear and greed score of 14/100 indicates extreme sentiment stress. If the VIX expands suddenly, dollar-yen could whip around violently. The low vol regime makes the chart fragile. A sudden spike in variance could invalidate the technical support at 155.229 instantly.
So we have a technical floor at 155.229, backed by flow data, but threatened by a potential volatility explosion. Moving north to cable, which is trading at 1.3453, testing the upper edge of its 5-day range ending at 1.3503.
Cable is approaching a key resistance cluster at 1.3503. Previous rejection on August 3rd established this as a hard ceiling. To break above, we need a close above that 1.3503 level. Currently at 1.3453, we are hovering just below it. The structure is bullish, but the 1.3503 level is the binary trigger for short covering acceleration.
The flow supports a continued grind higher. Euro longs are plus 1,269 net, and pound often correlates with euro strength during risk-off rotations. However, the sterling Swiss net short of 9,647 by leveraged funds suggests some skepticism about sterling's independence. They want the euro rise, but they're hedging against pound-specific weakness.
Sterling is caught in the middle. The UK economy is showing signs of strain similar to the US, but less acute. The 1.3453 price reflects a sell the dollar move rather than a buy the pound move. The narrative is purely defensive here. This brings us to the most anomalous data point in the entire book, dollar CAD. While the dollar is sinking elsewhere, dollar CAD is actually up 0.3% to 1.4018, holding inside a 5-day range of 1.39907 to 1.40803. This defies the broad dollar weakness. Why is the loonie immune?
Structurally, dollar CAD is respecting the 1.39907 low tightly. It hasn't broken down. The price action at 1.4018 suggests that buyers are stepping in whenever the price dips near 1.4. The 5-day high of 1.40803 is the next test. The chart is telling me that the Canadian dollar strength is holding firm against the dollar's decline.
This is where the COT data screams danger. Leveraged funds are net short Canadian dollar by 102,495 contracts. That is a massive bearish position built on the assumption that Canadian dollar will fall with the dollar. But Canada posted plus 75. 1K jobs against a plus 15K expectation. The fundamentals are beating the positioning. If those 102,495 shorts don't reduce quickly, we are looking at a squeeze.
The divergence is absolute. The U.S. non-farm payrolls was minus 23K, Canada was plus 75, 1K. The economic reality is screaming in favor of Canadian dollar. The fact that the price is only up 0.3% suggests the short sellers are stubborn, relying on the broader dollar index weakness to absorb the pain. But the plus 75, 1K data point is a structural shift for the Canadian economy, not a blip.
This is the highest risk setup on the board. You have extreme fear, 14/100, suppressed vol VIX 15.81, and crowded shorts, 102,495 net, against a strong economic print. If dollar CAD breaks below 1.39907, it won't be a gentle slide. It will be a liquidity event. The silence in the VIX suggests nobody is hedging this specific cross, which makes it explosive.
A squeezed Canadian dollar short against a strong jobs print. That is a potent mix. Let's look at gold, which is our third major focus. It is trading at 4,265.14, up 0.3%, nearing the 5-day high of 4,304.21. This is a clear safe haven bid.
Price-wise, 4,265.14 is extending towards the 4,304.21 high. The 5-day range bottom was 4,019.14. We are in the upper quartile of that range. A break above 4,304.21 opens the door for further momentum, but we are approaching a historical resistance zone. The volume profile suggests accumulation, but the proximity to the 5-day high warns of potential profit-taking.
Gold is the canary in the coal mine. With fear and greed at 14/100, capital is fleeing risky assets. The 4,265.14 price reflects a flight to safety. However, the Chinese central bank buying spree, mentioned in the headlines as continuing for 21 months, provides a structural floor. The demand side is robust, not just speculative.
The flow data confirms institutional accumulation. As noted in the headlines, China's gold buying spree continues. Combined with the leveraged fund rotation into yen and euro, gold is acting as the neutral ground between fiat currencies. The plus 0.3% move is modest relative to the fear and greed drop, suggesting there is still room for inflows before we hit exhaustion.
Be careful with the modest move. The VIX is at 15.81. If equity markets react negatively to the non-farm payrolls missed later in the day, gold could gap higher rapidly. The 4,304.21 level is critical. If it holds, it's a base. If it breaks, it's a breakout. But remember, the VIX suppression means the optionality for a violent spike is off the charts. One bad headline could push gold well past 4,304.21 instantly.
We've covered the dollar breakdown, the Canadian dollar anomaly, and the safe haven surge. Apex tie this together. How do we frame the session?
The overarching theme is a regime shift in dollar credibility, driven by the minus 23K non-farm payrolls miss. Grid identified the technical vulnerability in dollar-yen, approaching 155.229, and CIPHER highlighted the crowded nature of the Canadian dollar shorts at 102,495 net. Pulse emphasized that the 3.63% rate is no longer defending the greenback against the 3.46% inflation backdrop. SPECTER warned that the VIX suppression at 15.81 masks the volatility risk in these crowded trades. The synthesis is clear. Dollar weakness is the baseline, but the Canadian dollar cross offers the highest probability of a violent correction due to the disconnect between price and positioning.
To summarize, the U.S. dollar is under structural pressure from the minus 23K non-farm payrolls miss, with euro dollar and cable testing upper range boundaries. The Canadian dollar stands apart, buoyed by plus 75. 1K jobs, creating a potential squeeze scenario against the heavy short positioning. And gold continues to rally toward 4,304.21 as fear metrics hit 14/100. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Forex Edition. Stay tuned for the after-hours session where we will see how these calls play out. Until then, trade safe.